The next learning objective is to calculate operating income using contribution margin and contribution margin ratio. So let's get back to Lisa. Lisa is the college student that decided to start a small business operating out of her parents' garage. Her business is a merchandising business that sells jeans. She sells jeans for $50, and they now cost her $30. So it looks like the cost of her jeans has gone up from the previous slides. That's inflation for you. But that doesn't matter for this lesson. She has one other cost, rent. She still pays her parents $100 per quarter to operate the business out of their garage. So what kind of cost is the cost of jeans? Is it variable, fixed, or a mixed cost? The more jeans she sells, the more jeans she has to buy, so the jeans cost is a variable cost. The next question is, what kind of cost is rent? Variable, fixed, or mixed? Whether she sells 0 jeans or 100 pairs of jeans, the rent is still $100 per quarter, so it's a fixed cost. So if Lisa sells 1 pair of jeans, what is the gross profit on that pair of jeans? Remember, the formula for gross profit is revenue minus COGS, cost of goods sold. So she sold 1 pair of jeans at $50 and the jeans cost her $30. Her gross profit is $20. So this means that each pair of jeans contributes $20 towards covering the fixed costs, after which it then contributes to generating net income. So we have a new and very useful formula that is somewhat similar to gross profit. It's called contribution margin per unit. The formula is simply net sales revenue per unit minus variable cost per unit. Plugging in the numbers, we get $50 of sales revenue per unit minus $30 of variable cost per unit, which means our contribution margin per unit is $20. Again, this means that each sale of 1 unit, 1 pair of jeans, contributes $20 towards covering the fixed costs, after which it then contributes to generating net income. Be aware that the textbook also calls this unit contribution margin instead of contribution margin per unit. They both mean the same thing. Later we will find this contribution margin formula and concept to be helpful in calculating how many units a company must sell to break even, or how many they must sell to reach a particular profit level, such as $1 million. Here's a way students help to remember the definition of contribution margin. Contribution margin is the amount of revenue left over after variable costs are covered. In other words, it's the leftover amount that contributes to covering fixed costs, and once those are covered, it contributes to profit. In our example, Lisa's fixed cost, rent, is $100. And what's the contribution margin in our example? Well, each pair of jeans she sells contributes $20 of contribution margin. That means 1 pair of jeans contributes $20 to cover the fixed costs, which are $100. So Lisa would need to sell 5 pairs of jeans, 5 jeans times $20 contribution margin per unit, to cover the $100 of fixed costs and therefore break even. Then, if she sold 1 more pair of jeans to put her at 6 pairs of jeans, she would have $20 of net income. So let's start building a cost volume profit analysis toolbox. And the first formula we'll put in it is the unit contribution margin formula from the previous slide. Notice that the formula was expressed as per unit in 3 different places. We can remove the 3 unit parts of each variable and it becomes contribution margin equals sales revenue minus variable costs. So in this version of the formula, we are just taking total sales revenue minus total variable cost. So just as before, contribution margin is the difference between net sales revenue and variable costs. It is called contribution margin because it is the amount that contributes to covering fixed costs. So let's add this formula to our toolbox. So let's try an example. Let's say Ted's tablets sold 100 tablets. Each tablet cost Ted $100 to make. Before we move on, what type of cost is the tablet? It's a variable cost. Moving on, let's say Ted sold the tablets for $500 each. What is the contribution margin? Notice it's asking for contribution margin, not unit contribution margin. So we'll need to calculate total sales revenue and total variable costs. So let's plug in our sales price and cost to calculate total sales revenue and total variable cost. Sales revenue is $500 per tablet times 100 tablets. Then we subtract $400 of variable cost per tablet times 100 tablets sold, which gives us $50,000 of sales revenue minus $40,000 of variable costs, which means we have a contribution margin of $10,000. This means Ted has $10,000 of contribution margin to cover his fixed costs. If it was enough to cover his fixed costs, then the excess would contribute to net income. A third way to express contribution margin is as a ratio. The contribution margin ratio is the ratio of contribution margin to net sales revenue. So the formula for contribution margin ratio is contribution margin divided by net sales revenue. The formula just says sales revenue, but always know that whenever it says sales revenue, we really mean net sales revenue. We will add it to our CVP toolbox and then do an example. Because contribution margin is based on sales price and variable costs, which do not change per unit, the ratio can be calculated using either the total amounts, in which the formula is just total contribution margin divided by total sales revenue, or unit amounts. In other words, the formula becomes contribution margin per unit divided by sales revenue per unit. This is usually the easier formula to use. We'll do an example using both methods on the next slide and also explain what the result means. Because contribution margin is based on sales price and variable costs, which do not change per unit, the ratio can be calculated using either the total amounts or the unit amounts. So we're going to use the same example as before with Ted's tablets. Ted's tablets sold 100 tablets. They cost Ted $400 to make per tablet, and he sold them for $500 each. Using the contribution margin ratio formula, what is the contribution margin ratio? Notice the formula starts with contribution margin. So what is the formula for that? Using our toolbox, we see it's sales revenue minus variable cost. So our formula now becomes sales revenue minus variable cost divided by sales revenue. Now we can plug in the numbers. Sales revenue is the $500 price times 100 tablets minus the variable cost, which is the $400 cost per tablet times 100 tablets, which is then divided by sales revenue, which we already calculated, $500 price times 100 tablets. This gives us $50,000 minus $40,000 divided by $50,000, which when we do the math eventually gives us 0.20. If we multiply 0.20 by 100 and attach a percentage sign, we get a result of 20%. Now this was done using the total amounts method. A simpler method is the per unit method of calculating contribution margin ratio. instead of contribution margin divided by sales revenue, it becomes contribution margin per unit divided by sales revenue per unit. Then we replace contribution margin per unit with sales revenue per unit minus variable cost per unit. So our new formula is simply sales revenue per unit minus variable cost per unit divided by sales revenue per unit. Plugging in the data, we get $500 sales price per unit minus $400 variable cost per unit divided by $500 sales price per unit, which eventually gives us 20% again. So what the 20% contribution margin ratio means is that the amount each tablet contributes to covering fixed costs is 20% of the sales price. In this case, 20% of the sales price is $100. I got that by multiplying $500 sales price times 20% contribution margin ratio. So selling one tablet contributes $100 of contribution margin to cover fixed costs. Once fixed costs are covered, the contribution margin contributes to net income. As I'll show you later, having a breakdown of your variable costs and fixed costs allows you to answer a lot of management questions, such as, how many units must we sell to break even? How many units must we sell to have a profit of $1 billion? What happens if we were able to lower our fixed costs, etc.? But a traditional income statement, like the income statement on the left, does not show us our variable costs versus our fixed costs. The traditional income statement classifies costs by function. That is, costs are classified as either product costs or period costs. Remember that product costs are those costs that are incurred in the purchase or production of the product sold. For manufacturing companies such as TEDS tablets, the product costs are direct materials, direct labor, and manufacturing overhead. These costs accumulate in the inventory accounts until the products are sold. At that point, the costs are transferred to the expense account called cost of goods sold. The period costs are the selling and administrative costs. The income statement on the left uses the format required by GAAP. GAAP is generally accepted accounting principles. Because the traditional income statement on the left does not always provide enough information for managers, an additional format is needed. A contribution margin income statement classifies costs by behavior. That is, costs are classified as either variable costs or fixed costs. Notice the contribution margin income statement highlights contribution margin, a number we will be using a lot in this chapter to solve management problems. So as you can see, the formula for the contribution margin income statement is pretty simple. Net sales revenue minus variable costs gives us the contribution margin. We then subtract fixed costs to get operating income. Notice that both variable costs and fixed costs would both be a combination of some product costs and some period costs. You may be wondering, where are the mixed costs? We've shown previously that mixed costs can be broken down further into their variable costs and fixed cost components. Now notice both income statement formulas end with operating income. To simplify things, you can just think of this as net income. But technically, operating income is the income before other revenues and expenses, such as interest expense, and before income tax expense. I'll show you this on the next slide. So here is operating income on a traditional income statement. Notice it's before other revenues and expenses, and also before income tax expense is subtracted. And once we subtract those two, we get net income.